Ready to go when you are.
All right, I am here with the illustrious Matt Cashman of OCC fame. Many of you have. Hello to everybody. And for the record, today is Monday, September 15th at 1 p.m. A sleepy day today, Matt. So we have a great topic. Now, unbeknownst to me, you just did a great webinar on some of this topic. So we're doing a little bit of overlap here, but it's fun to do this with the SpotGamma community because a lot of you understand the ideas of Delta hedging based on the way we track dealer flows. And so when Matt came and said, "Hey, what kind of presentation you want to do?" I said, "How about Delta and Gamma hedging?" And he said, "I have just the PowerPoint for you," which I was happy to hear about. So, Matt,
fresh off the presses, Brent. Fresh off the presses.
that's right. So I rudely just sort of started speaking without giving you a formal introduction, but I'll give you a second to introduce yourself because we are streaming this one live. So hopefully there's a bunch of people here who are not yet in the SpotGamma ecosystem, but will join after hearing this beautiful conversation.
Amen. All right. Well, my name is Matt Cashman. I'm the principal of investor education at OCC. I have been an options trader for about 25 years. And over the last 4 years, I've started taking all of that experience that I have in the options world and trying to package it up into educational elements that people can understand easily about options. So I spend all of my time teaching people how options work now, which is great because it gives me an opportunity to use all the experience that I have for the purposes of good and not evil.
I'm going to say this. I was fortunate to be on the SIBO floor to do a show with Oliver Rennick, Chicago Future of Finance.
Yeah.
And who should walk in but Matt Cashman? And you would have thought that Kim Kardashian or Sydney Sweeney had walked onto the floor. All these guys come rushing over. Matt. I don't, I like to think I don't have any kind of ego at all, but no one gave a flying, that I was there. They didn't know who I was, all that sort of stuff, which is fine. But I did get a little jelly when everyone's like, Matt Cashman.
Well, I will say this, Brent. I don't believe you ever stood and traded in that pit, which is what I did
definitely
for
not.
almost a decade. So that's the reason why. Strangely enough, or I guess not strangely enough, many of the same people that I used to stand with there in 2015 when I left are still there. And that's part of the reason why they came over.
They're bored.
I haven't spoken to any of them since then. So
that's so funny.
You can call it Kim Kardashian-esque if you would like, but I don't think that's what it is. I think it was more they had seen an apparition or a ghost and were spooked. But either way,
that's funny. All right, but that was nice to see. Everyone's so excited to see you, and so I've done enough wasting everybody's time here. They're here for the payload, so to speak, the beautiful content. What we're going to cover today is delta hedging, and a lot of you know, and we're not going to confine ourselves to this space, but this is going to be the jump off topic. A lot of you know about this from the dealer hedging perspectives. We cover it in depth kind of every single day when we're talking about Delta, Gamma, Vanna, blah, blah, blah. And the idea here with Matt is to dial in maybe how we can use this ourselves as better traders to hedge positions or to adjust positions, or even maybe we'll get into some strike selection and the best way to sort of optimize your view on things. So I'm really excited for this. As I did mention, I was teasing about the presentation, but it was really pretty neat. He had some great slides in there. So Matt is going to be mainly in the driver's seat. I'm hoping to learn a bunch of things. I'm sure I will. I always do. You're going to break out the puts over conversation again, which I learned about from you last time.
puts over versus calls over. Yeah. Okay.
I remember that.
Yeah. Good.
Puts over.
Good. I'm glad.
Puts over was ringing in my ears for weeks. Yeah. Yeah. So take it away. I don't know if you want to start with the slide deck. I know you got prepared there, or if you'd want to.
Yeah, sure. Let's just talk about. Let's start kind of from the beginning, right? I mean, much of your audience is going to know this, but Delta is really how the option value is going to move relative to the stock price, and so that's something that a lot of people are going to understand very intuitively. But sometimes what I like to do is break down the idea of delta into what I call hard and soft delta. And I don't know if we've talked about this before, but hard delta is something that's going to act a lot like the underlying stock,
Mm-hmm.
right? And so like hard delta is in the money options, options that have high deltas, right? Or options that are very close to expiration. Those options with high deltas are going to act an awful lot like stock. And so when I think about hedging, I think about hedging with stock against things that have hard delta as a way to reduce variance, right? And
Mm.
so when you hedge hard delta with stock, you're reducing variance because you're hedging. I want you to think about it like this: option delta with stock delta. And when it's hard delta, it's going to act an awful lot like the stock does, right? Contrast that with what I call soft delta. Soft delta is low delta options that are not necessarily going to correlate perfectly with underlying movement. So these are options that are farther out of the money or have a lot of time left in them. So if you're hedging soft delta with stock, stock is the ultimate hard delta, right? Stock hedged against soft delta is going to be something that actually increases your overall variance. It doesn't decrease it. And so when we're talking about delta hedging, I want everyone to start to think about how, because oftentimes the delta number can be somewhat like misleading if you look at it, if it's coming from soft delta or if it's coming from hard delta, because 1,000 deltas of an in the money call versus 1,000 deltas of an out of the money call is going to be completely different from a P&L perspective, not only leverage, but also variance as far as the underlying is concerned. So I'll leave it there for a moment because I think that's a conversation. Do you guys talk, Brent, an awful lot about hard or soft delta, or do you just think about it as like out of the money or in the money delta?
I would say we generally talk about it as in the money or out of the money delta, and so the sorry, we had an echo. I got rid of it by putting headphones in. Sorry, everybody. Yeah, so I like this idea of hard or soft delta, and the way that we would generally think about it is what is the reaction kind of to a certain move. And so I think when you're talking about the increase or decrease in overall variance, it totally makes sense and clicks when you relate it to the idea of hard or soft deltas. And I think that's more of like a trader terminology that we don't tend to use around here. So I like that idea. It's one more thing I can confuse people with, particularly when I go to use it inappropriately. So I really
or decreasing variance. Yeah,
I really like that idea. The other thing that just popped in my head is that we see a lot of trades oftentimes that'll be one option tied up with another that'll be like a deep in the money option, or it's clearly a combo or a risk reversal. And the idea is you're basically printing an option that is, for lack of a better term, synthetic stock, I guess is how I'd put it, as a way to hedge. And I think a lot of times, particularly when you're seeing these flow people put trades out and they go, oh, it was a $1 trade that just went up. That's just a sort of synthetic stock position that printed, and it's using delta as essentially, again, in lieu of stock.
Correct. It's basically synthetic stock, and you can think about it in the terms of hard versus soft delta as the closest approximation to hard delta that you can possibly get. If you have a deep in the money combo, which is like a long call and short put on the same strike that's in the money, what that means is that it's going to act almost essentially like stock, right? It's going to be kind of correlated value wise to the stock, and it's going to be, and that is, hedging. If you were to hedge that with stock, it would be basically like locked up a conversion or a reversal or whatever that would have almost no delta exposure whatsoever. So, but most broadly, I want people to understand, if you're an option trader, if you're a professional option trader, what you really want to do is hedge option delta with as much other option delta as you can. Because what you're really doing is hedging like to like, right? Those two things. And the reason why is because oftentimes if you have option delta, it's not just delta. It also comes with oftentimes the gamma that's associated with it, or the vega exposure, or whatever. And the underlying, the stock or the futures, if you're trading indexes, doesn't have any of that. All it has is delta, right? Mm-hmm. And so if you're hedging, the thing that I always wanted to hedge longer dated optionality with was longer dated optionality, and shorter dated optionality with shorter dated optionality. I never really wanted to hedge it with Delta. Delta is like the last kind of, or hedge it with like underlying Delta. Delta is like the last resort, right? It's extremely available and very liquid, but it also doesn't have any of the Vega characteristics or the theta characteristics or the gamma characteristics that come with other option Delta. So think about it that way. Okay.
I like that idea. And another thing that came up briefly this morning, which is a slight tangent, was somebody asked about Tesla was up this morning 7%, right? And because Elon bought $1 million and now the stock's at 420, haha. And the idea of like when the options market's not open for the single stock, what is a dealer to do when the options market's not open, and you can't really hedge that Tesla move with QQQ deltas or Nasdaq futures or whatever, right? Like you're kind of forced, because it's idiosyncratic risk. You're sort of forced to buy Tesla stock, I would think, because it's again this idiosyncratic move. It's specific to Tesla, and it's powerful, and you can't sort of like sit there and be like, I'm long some Qs, so we're good.
Yeah. Yeah. I mean, some people do hedge it with Qs because the Tesla is a certain percentage of the Q, et cetera. And they soft hedge it with a certain percentage of the Qs relative to their notional value. Of course, you can do that. That gets really complicated. And it also has a lot of variance built into it, right? The Qs aren't going to necessarily move in the same way that Tesla does. So that's a whole part of that. That has its own kind of soft delta idea to it, right? The delta of the component piece relative to the index that it is a part of that index. It's a lot. So the other idea that I want to introduce here that you and I were talking about briefly beforehand is the idea of the delta of these options as a function of implied volatility, because this is something I don't think that gets talked about very much. So when we're talking, and when we started talking about this briefly beforehand, you said, you know what, this is interesting because of the amount of how low the implied volatility of the overall market is right now. And I completely agree that this is a function of that. I want people to think about delta as, and what you can look at here. Let me get the old laser pointer out. So these are, right, this is essentially the same option, and the strikes are on the bottom, like the 40s, 45s, 50s, right? This is the 60 strike, which would be like, let's assume we're talking about a $60 stock here. These are the at the money options. These are your in the money calls down here. These are your out of the money calls over here. And so you can see when you have a very low or relatively low 20% implied volatility, this is what the actual deltas look like. This would be a 100 delta option. This would be a 0 delta option. And so the 40 calls and the 45s and the 50s and the 55s, right? 100 delta, 100 delta, 95 delta, like 92 delta. And then you get into the 60s, which is the 50 delta. And then the exact opposite happens on the upside calls, right? They go very quickly from the 50 delta down to, 10 delta, 5 delta, 2 delta options. The reason why is because when you're assuming a very low volatility of the marketplace, what you're saying is the in the money options are very likely to stay in the money, and the out of the money options are very likely to stay out of the money. And so what you're really doing is you're concentrating all of the movement and the potential movement in, guess what? These options, these 50 delta options, the 60 delta options, like those are the delta options that are going to move around. And the rest of these, their deltas are they're not set in stone. I hate to use that term, but the market is assuming that if you have 100 delta now, you're probably going to have 100 delta at expiration. As you see these implied volatilities increase, right? 20 implied vol, 40 implied vol, 60 implied vol, 100 implied vol, you'll see that the actual distribution of the delta starts to flatten. Why is that? The reason why is because if you go from a 0 vol all the way up to an infinite implied vol, what you're really doing is assuming at an infinite implied vol that everything has the characteristics of a coin flip, and a coin flip has a 50 delta. And so all the options start to move toward 50 delta. That means if you have an in the money call that's 100 delta and you raise the vol on it significantly, its delta decreases. It doesn't increase, it decreases. And if you have that same call in the out of the money area at a low volatility and you raise the implied volatility on it, those calls increase in delta, because as you raise implied vol, everything tends toward a 50 delta. So that's something that I don't think people talk about enough. It's as you said, Brent, earlier, you call this Vanna. Well, not Vanna, you call it what do you guys call it? But yeah, Vanna, right? You call it Vanna. It's the difference in delta relative to implied vol. So what do you think about this?
I think that sensitivity of the delta to the implied vol makes sense. Now, as the delta gets less sensitive, you would, in theory, if you own puts, you have some Vega exposure that would kind of offset, right? So what Greek is driving your P&L, I guess, changes in this instance where because my first thought when I look at that is like, oh, I'm going to make less money if the market goes down because my delta decreases. But
always.
In theory, your vol should be increasing, or your Vega should be increasing, right? Your P&L from Vega, if implied vol really jumps.
Yes, if the reason why the delta of the option is decreasing is because you're adding duration to it, right? If you're pushing it further out on the curve and it's a longer dated option, then it's going to have a different mix of gamma and delta and Vega. That's where the Vega would come in, right? Like as you're talking about, the compensation on the downside might be from the Vega exposure of that option because it's a longer dated option, right? That's where you would get that kind of mixture. That's where duration comes into play, right? And that you can tell from, let's see.
You just said a minute ago, as implied vol works towards infinity. What is the highest implied vol you've ever seen? Something. What's the closest to infinity?
The highest implied vol I've ever seen.
For like a reasonably liquid instrument.
Oh, reasonably liquid, I would say well into the hundreds, 300, 400, 500.
This was GameStop was like 450, I think is what it was.
Yeah, it's in that range. So this is the same thing, but for gamma, right? And this tells you exactly what we're talking about here. And this is why that delta moves the way that it does. This is the lowest implied vol, means that the gamma is most focused in the at the money options. And then as the implied vol increases 20, 40, 60, 80, 100, you see the gamma of those options start to spread out and be more evenly distributed across all of the strikes because of exactly what we talked about, which is if all of those options are tending toward a 50 delta, that means all of them are going to have the same amount of gamma, which is basically zero once you get to infinite vol, right?
Right, and the thing that strikes me about this is that when we're in this really low vol environment, from the hedging flows perspective, when we think about pinning and low vol market and the reflexivity of it, because as vol comes down, gamma gets more concentrated. So if you are this proponent of dealer hedging flows or watching them, like obviously I am and a lot of us are here, then you're getting more gamma is concentrating more at certain strikes where these big positions are. And as vol comes down, it almost seems to then kind of reflexively concentrate that positioning, even more. And then if vol spikes, then that gamma kind of disperses, I guess is the way I would put it. And you can see there as that curve flattens out.
And that's what you're seeing right here, right? That's where this is a low volatility environment. All of the gamma is focused around those at the money options. And as the vol were to go up, right, the gamma of those options starts to get more dispersed, just like Brent said. And so that's part of the dynamic hedging that you're seeing right now in this marketplace, is that when people have a ton of optionality on their sheets, they end up hedging a lot, right? Because they have to.
And then you have to figure into this, I guess, somehow the sort of event vol, I guess, is another interesting part of this. Like you have an FOMC coming up, and so your gamma profile could probably change pretty drastically, before and after a singular event, right?
Oh, absolutely. Yeah.
So your
gamma profile,
jump risk, I guess.
Yeah, your jump risk, and also as a function of time, right? I use this slide all the time. This is gamma of the at the money option relative to duration, right? And this is something I think that people are starting to understand a little bit more intuitively as they engage with optionality, is that as you go further out in time, right? This is 90 days. This is 30. Let me get the laser pointer going again. This is the 90-day option, the 30-day option, the 10-day, the 5-day, and the 0-day, right? This is the same exact option, the at the money option, over these different durations and the gamma that exists there. And so the gamma, I always say this when we're talking about gamma, the the most highly concentrated gamma option is going to be at the money in the shortest time to expiry. If you're looking for the highest gamma option on the board, you need to be looking for the at the money option that's about to expire, because that's where the gamma is going to be most concentrated. Now, that doesn't necessarily mean that that's the best option to trade. I'm just telling you from a theoretical perspective, like that's where it is. And then as you add time to those options, it decreases in gamma as it goes out.
That's why you like to sling those 0 DTEs.
Love it. Love it.
Now, previous
Brent, I do have to say, I am not allowed to trade anything that OCC clears, nor do I ever trade anything that OCC clears.
That's right, in full compliance. That doesn't mean I can't tease you about
also true.
OCC is going to say no more SpotGamma interviews. The previous slide, though, you showed with implied vol. Now, I've showed a similar slide with replacing implied vol with time decay, right? Because or theta or time, because the most concentrated gamma position would essentially be the 0 DT option, right? And then the farther you go out in time, the more, the flatter you get, that curve flattens out.
Yes, absolutely. And it's all because of the same reasoning, right? It's all because of the shape of the distribution as you either add implied vol to it or as you add time to it. It's similar in both. So when we're talking about, I want to show people this. So when we're talking about the straddle, the at the money straddle, and the reason why people hedge in the way that they do, this I think is helpful for people to visualize how the at the money straddle works. Because if you think about it, let's assume this is a $50 stock. These are the puts in red, right? And these are the calls in green. And this is your at the money option right here. So the red and the green is the at the money straddle with the stock trading 50. And as you go down, right, the 45 put is what starts to kick up and the call starts to lose. And then as you go down more, right? And so I think about this whenever I think about options, and particularly when I think about straddles, I think about them as big blocks of premium that are both expanding and contracting as you add time or subtract time, or you add delta or subtract delta from them. And that's really what this is meant to show you, that like as you go up, the calls gain in value and the puts lose in value. And as you go down, the puts gain in value and the calls lose in value because of their delta, because of, all the gamma that's associated with them. But I think sometimes this can be a good visual for people to understand how the straddle itself moves as things move. And so when you're moving to the downside, what people are actually hedging is this, right? This put is getting bigger and bigger and bigger and bigger to the downside. And when you're moving to the upside, what you're hedging is, if you own straddles, this call is getting bigger and bigger and bigger and bigger. And thus you're selling deltas against the call side expanding. And on the downside, you're buying deltas against the put side expanding. And it's good for people to kind of visualize that and think about that as the way things are moving, because the important thing, and this is what Brent and I were talking about beforehand, when you're talking about movement in the underlying, especially when you're talking about strike selection and things of that nature, if those options aren't gaining value to the downside, if you're dealing with options that are out of the money, remember, soft delta, right? And you're thinking about hedging them with underlying stock or futures, you're talking about hedging soft delta with hard delta. And so this tells you, right, this is like when these things get real big, that's when they start to have actual hard delta. And that's when people start to think like, okay, now I need to be hedging this like with like, right? The option delta starts to become like really hard delta. It's going to start to act like stock. I can hedge it more with stock. But if that doesn't happen to the downside, then buying stock against an option position that you're moving down into is just actually increasing the variance of the position. Does that make sense?
I'm with you. So the thing that I would think about here is that if you, and this is going to come up later, I imagine, that if you wanted to make this a delta neutral position, you would have to offset the red or the green block, right, to make it neutral, which make it look like the 50 delta position, right? You want to even those blocks off.
Correct. And really what you're doing, if you do that, let's assume the stock went from 50 down to 40 down here, and you buy a bunch of stock against it. What you've done is you've taken this block, which is very put centric and not a lot of call value to it, and you've rebalanced it so that it's going to look more like this, but just down here, right? You bought stock at 40. Now what you've done is you just take this entire graph and you kind of like move all of it down to 40. And now you've hedged it on a 50 delta down here. You've basically said to your position, okay, now we own the at the money option again, and we're balanced. We bought stock against it. Now you don't care about movement one way or the other again. You don't have directional movement. You just have vega and gamma and theta exposure. And so you've become delta neutral, and that resets this down to, this will bring this down and this up basically just by buying stock down here. And it resets it to make it look more like this, but down at 40. So does that make sense
to me? Yeah, it makes sense to me. Okay. I can see the live chat here. So if this stuff is making sense, let us know. If it's not, let us know. We'll reset. But I like that visual. It makes a ton of sense to me. And then in theory, if you're buying or you're reweighting your position with the stock at 40, if the stock bounces to 55, then you're going to reweight again, right? So you're going to sell the stock that you bought in that case, which would give you the rebounds.
Exactly, which is how that's essentially what people are doing when they're gamma scalping. They're just taking their option positions and constantly recentering them every time the thing moves. And option market makers do that in many different ways, but they do it kind of in real time. Their actual positions ask them to do that in real time, right? And different people hedge in different ways. Like, don't ever forget that as well. You talk an awful lot about positioning and what the market has most broadly, but I've said this before. There were times when I would stand next to someone and we would both buy the same option, and I would buy 20 deltas versus it, and they would buy 28 deltas versus it because of how they have it modeled. Because they have a steeper vol path on the thing if it's a put, or a shallower vol path if it's a call. And so that can change also. You don't necessarily know how people are going to necessarily hedge. And then there's also a time horizon to hedge. Some people hedge on a, like every 30 minutes, every 60 minutes, every 90 minutes, or daily, right? I used to hedge my relative value book close to close. I would wait and let the move happen, and then I would hedge on the close. And the reason why is because I had two relative value positions that were kind of like held against each other in sometimes assets that weren't perfectly correlated. And so you had to let the move kind of happen in the way that it happened, and then see whether or not you got outperformance on the side that you were long or underperformance on the side you were short. Those are obviously the best scenarios, but oftentimes it would be underperformance on the side you were long and outperformance on the side you were short, which is bad in a relative value context. Either way, hedging is an interesting kind of phenomenon that we don't know a lot about exactly how everyone is hedging all the time.
And you're not guaranteed to win when you hedge either. I think a lot of times it seems quite simple, and then I've had positions in my own little portfolio where I just sort of make a mess, right? Because I'm trying to hedge it here, buy it here, sell it here, move up and down. It's sort of like if I just bought the option and didn't do anything, I would have done better. So I've made a mess many times in my life, over hedging or under hedging or whatever it may be. Chris Daly's asking, and I'd love your a little bit of more detail on this. When you say increasing or decreasing your variance, do you want to elaborate on that one a little bit?
Sure. So increasing your variance essentially means that if, let's say that you're long the in the money call and it's like a 90 delta, and you have no stock against this option, what you have essentially is kind of like 100% variance. The reason why is because your P&L is dependent 100% on how the stock is moving. And so that option is going to move 90% of the stock, theoretically, according to your model. Now let's say against that, you hedge 50% of that delta. You hedge it with 45 shares of stock. What you've essentially done is you have taken the amount of variance that you would have, meaning your correlation to the underlying price movement, and you have lowered it by selling stock. Again, if it's an in the money call, you've basically lowered it by selling half of the delta in the actual underlying, so that as the stock goes up, right, your call that's 90 delta is going to go up in value 90 cents for every dollar, but you have half of that delta hedged short in the market in the underlying. You're short 45 shares of stock. So while the stock is losing money on the upside, the call is gaining money on the upside. But what you've done is you've removed the actual dependence that you have on the underlying movement. You've removed your exposure to the underlying by hedging half of it. Now let's assume you hedged not like 100% of that delta. You sold 90 shares of stock against it. Well, what do you have now? You have almost zero reliance on the underlying movement until the stock goes down through the point where you have no delta in the call and you're just short 90 shares of stock. And so at that point, what you're getting is now you're getting increased variance as the stock goes down, and you don't have as much call premium against stock that you've sold. So the reason why I bring it up in that regard is because I want people to understand that variance is something that is inherent within the optionality, particularly when you're talking about the delta, right? Delta in many ways is variance. It is reliance on the underlying of the stock and the movement there. So when I talk about hedging hard delta versus soft delta, and if you're hedging hard delta with hard delta, meaning in the money delta versus stock delta, that is actually a reduction of variance because you're not quite as exposed to the delta as you would be otherwise. And if you have soft delta and you're hedging it with hard delta, meaning the underlying, you're actually increasing the variance because you're hedging not like versus like. You're hedging something that's going to move at 100 delta with something that might only move at a 20 delta. And so that's kind of, I hope I explained that well.
I think it was a great explanation. It makes sense to me. So we were thinking about Oracle the other day. It was up 40% overnight. And when I was looking around, trying to find ways to sell some of the call skew that was built up in that name, it was tricky because you could sell a call for what I believe to be an elevated implied vol, but the stock could very easily drop 20%, right? It's still up 20% on the day. It's just, it was extremely squeezed. And so it was, you can't really short that vol unless you are really adjusting to this variance that you just mentioned, right?
Yes, and if you're selling those calls, were you thinking about selling those calls delta neutral?
Well, this was sort of the way that I was trying to structure it. So I was actually buying short dated puts as well, like put spreads, as my way to get deltas to the downside rather than shorting the stock.
Were you hedging in, or were you buying them naked?
I was selling. So what I ended up doing was I was selling some calls, and rather than go delta neutral, because what I've also had trouble with in a stock when it gets to $300 or $400, right, is like you can start to run into margin issues, right? So I tend to run those positions pretty small, where I'd rather just sell a small number of calls where I don't have to get in a situation where I try to hedge those hedge out those positions. And so what I did in this case was I sold some calls, right? October, I think I did 350s is what it was, kind of at the money calls. And then I also just shifted more to a short stock strategy because I didn't think I could really get exposure to volatility in a meaningful way. Like the vol wasn't that high that I felt like I was going to get really paid to be short this call. And so what I was really, when I dug into it, and sorry everyone for the background noise, what I really happened when I dug into it was I was just trying to get short that stock and bet on mean reversion, and doing that through shorter dated puts seemed to make more sense to me.
Yeah. Well, I mean, and that does make sense. I think the thing that you need to always keep in mind is anytime you're selling, like if you're selling calls in a situation like that and you're not just selling them naked, you are also selling some amount of the vol, right? You are selling some exposure to the underlying. So if you're hedged delta neutral, you are your exposure is to underlying movement as well, right? You're not just short call premium. In situations where, for instance, I used to trade soybeans a lot. In situations where things got completely bananas as far as the upside is concerned, and people would come in and pay like, $5 to $6 over your sheets for calls, oftentimes we would have the question like, how do we hedge these? What's the hedge here? Because in some cases you're like, well, I have an implied vol that tells me that the thing's worth 2. But if someone's paying 6 for it when I have it worth 2, how do I hedge this? Do I take the implied vol up to where it's actually trading and then hedge it delta neutral? And the answer to that is, if you and this is what I intuitively believe, if you have enough flow that's coming in and out that you're trading back and forth, then yeah, sure, take it up to the implied vol that it's trading and then hedge it delta neutral and then just start trading, right? Like I'll buy some of these, I'll sell some of these, I'll buy some of these and do that thing, because what that means is you have a position that is going to have enough flow to kind of, you don't care where the implied vol is really if there's enough stuff going on. But if you're just selling the calls and you're like, I really think these things are worth 2 and this person just paid 6 for them, there's a difference between how sometimes people think about that and they look at it and they say like, I don't want to hedge this on 100 vol, right? Because if I hedge it on 100 vol, what does that mean? If I'm selling out of the money calls, that means that I'm actually buying more delta in the underlying against that trade. Remember what we talked about, right? Like this thing, right? If that's the out of the money call and you raise the vol from 20 up to 100, all of a sudden it goes from basically a 0 delta up to like a 35 delta. Well, that means if someone comes in and buys this call from me when it's a 20 delta or when it's a 20 implied vol, I don't really buy any stock against it if I'm hedging delta neutral. But if we're trading on 100 vol and someone buys that exact same call, I sell them the call that's worth, in this situation 6 instead of 2, but I also buy 35 shares of stock against it. That completely changes what your P&L looks like, right? Like look at that versus what it looks like when you just sell the call and it has no delta. Now, it has much more risk to the upside here because you're not buying any stock against it, but it has way more risk to the downside here because you're buying 35 shares of stock against it when you sell it, right? That's a big difference. And the P&L is going to look completely different to the downside on this trade and to the upside on this trade.
And then not only do you have to understand this dynamic, but then you have to be able to predict how vol is going to change, right? Because that's not set in stone either. And so just back to the Oracle example, I sell a call and I get long stock. I've had it happen many times where the stock goes down 10%. I get crushed on the long stock component, but I'm not really getting paid on the short call because it takes the short call a little while, a couple of days maybe for that vol to come in, right? And so
Correct.
you're initially you're locally balanced and you're feeling good, but then when the stock drops 20% and vol doesn't come in, you get crushed on your short stock, or excuse me, your long stock position, and the short call that you sold, which may have been rich at that price, didn't decay enough or didn't reduce. You didn't make enough P&L on that position when the stock drops.
Yes, correct. Because essentially, and if you were sitting and talking with like 2 professional option traders, they would just say, yeah, you were basically just short puts, right? Because the thing is going to P&L like you actually are short puts until the vol comes in, and then, right, then the sizzle happens and the whole thing, right, starts to like come in and you get some of that P&L back. But what you're getting initially is the delta P&L from buying all that stock against those calls you sold if the stock were to drop.
Right.
Now, if the stock were to continue going up, you'd be super happy that you bought 35 deltas worth of stock against it. But that's not, like you have to be able to balance those 2 things. And when you're in a situation where the delivered vol is through the roof and the thing's all over the place, you need to make sure that what you're doing is what you're intending to do. Because oftentimes
Yes.
what you can do is, right, like, oh, I'm selling calls, I'm bearish, right? And then it's like, oh, wait, no, I bought too much stock and the stock's down 20%. I was actually making a bullish trade when I thought I
Yeah.
was making a bearish trade, right?
Right.
So think about both sides of the trade that you're making, not just, especially if you're trading delta neutral, not just I'm selling calls, but like, what does it look like if I sell calls and buy stock against this if the stock goes down 20%? So I
And
would say
that
that is
that
a really important part.
and that goes back to the idea of just buying short dated put spreads instead. If I really just ultimately what I'm thinking is the stock's going to come down and the vol wasn't that wasn't high enough to justify being short the calls. Now I could have just stayed
Yeah.
short smaller numbers of calls and just let that ride instead. But at the same time, I don't like being short a stock that's already up 40% and it's already doing stupid things, and stupid can always go more stupid.
Yeah. More stupid is as stupid does. Yep, for sure. And things
Been
can
there too.
always get super, super, super weird, right? Like, I mean, anyone who's traded through GameStop or through something like 2008 understands that, like, markets can do very, very irregular things when those situations occur. But let's talk about the situation you were talking about earlier when you were talking about that downside put fly.
I like this idea. I have been persistently pitching out of the money 100 strike wide S&P put flies and kind of rolling them. So today my idea was the Friday PM 6400, 6300, 6200 put flies. Matt has nothing to do with this recommendation. OCC is just an idea that I rolled off, and it cost $1. And so when I think about these, I'm like, I could buy 10 or 20 of these, over the next 6 months. And if one of them strikes, right, if one of them moves in the money, it could be a real nice payday. But the idea of where you put those strikes, the distance that you go from the first leg of your fly, and what it is you're trying to hedge. So it's like, I was telling Matt that a lot of people say, well, Brent, where do you think the market's going to go? When I look at the setup of the market right now, I'm like, I think we could easily move down to 6,400, right? So that would be the move. The S&P moves into that level. That's kind of when I want to monetize some of my hedges. And I think naturally a lot of people would say, well, why don't you do the 6,500, 6,400, 6,300 put fly, because you would sell two at the strike that you think the market will stop. That's the stop in the market, right? Hopefully I explained it the right way. But I slide it down, number one, because it makes it cheaper for me, but also when the market starts to move down, that 6,400 put is going to really wake up a lot faster, I believe, than the 6,300 puts, because those 6,300s are still so far out of the money. So I'm essentially trying to buy a very cheap put spread that I would look to monetize if we started to get a 1 to 2, maybe 3% down move. So I would probably monetize that position well in advance of getting to 6,400 is what I think. And your view of that was like you're just basically getting long put skew, I believe, is how you placed it. So I'll pass the baton to you, and you can correct the things I just said.
Well, I think there's no correction here. There's no correction. I think what you're talking about is what we see here, which is kind of interesting when you're talking about the delta and the movement that happens on these put flies. Oftentimes, people. Let me see if I can get my laser pointer to work. There we go. So you're talking about something that kind of involves something like this, but shifted down a little bit. This is what we're looking at here is the delta of the 50 put right here on the move down. This would be down. Obviously, stock price is down here. The delta of the 40 strike put, which would be the 25 delta to begin with, and then the delta of the 30 strike put, which starts out as a 10 delta. So in this case, you could look at this and say, this would be something like the 50 delta, 25 delta, 10 delta put fly, right? This structure right here involving these three. You'd be buying one, selling two, and buying one.
Yeah, and
So Brent's saying we would shift that down a little bit.
The Friday put right now is a 10 delta. So that thing had no, that I think has the market is telling me no prayer of making it down there.
Yeah, exactly. But what I want people to do is think about how these options and what Brent's talking about in some ways right? When you talk about them, when you add duration to these options and they have Vega and things of that nature to them, they have a different characterization. But when you're talking about it like in a 0-day option, you're talking about something that really only moves as a function of its delta, right? Like delta is kind of the only thing that matters when people are talking about these options. And so when you're talking about this 50 strike put that has a 50 delta, it's going to move very, very one-to-one with the marketplace, especially as it goes down, right? It's going to start to increase more regularly in price and in delta on the way down. These other options, this, remember, is the 25 delta put that starts at 25 and the 10 delta put. These take a little bit more time on the downside to start to kind of, as it were, I call it like wake up, right? They take a little bit of time to wake up to the downside. And that's where you see the curvature that exists here on the actual 25 delta put, and then the real curvature that exists here on the 10 delta put. And so
Now,
you're talking about that structure on the way down. Yeah, Brent, go ahead.
Now, in this case, implied vol of that option is it's a 23. It's pretty far out of the money, and at the money, implied vol is like a 12, right? So if if the market does start to drop that much, right, we have a dynamic delta situation here because implied vol has only one way to really go up. I mean, of course, we could bleed a little bit lower, but let's just say we're on the floor, so implied vol can only go up. Let's just agree on that for sake of conversation. Then that shifts this around, right?
Yeah, it totally shifts it around. And what I said to you earlier when we're talking about something like the 62, 63, 64 put fly in that situation is really what you have on here is the 64, 63 put 1x2 with the cap of the 62 put against it. What you're really trading here is that put 1x2 because the 62 put, as you said, right, is priced in a way that the market is saying like this thing doesn't even matter, right? It's priced, it doesn't. And so while that is something that you keep on your books to make sure that your margin doesn't get completely out of hand, what you're really trading, and this is something that takes a little while for people to trade and then understand, what you really have on in that situation is the 63, 64 put 1x2. And that's how it's going to P&L, right? And so in what situation does that thing, if you're going to be long it, if you're going to be long the 63, 64 put 1x2, in what situation does that thing go bid? What needs to happen, right? Think about that. And Brent, what do you think needs to happen for that thing to go bid to the one? Because it's the 64 once versus two of the 63s, right?
You need like VIX 80.
No, actually VIX 80 would make that thing go offered.
Oh, go the other. I'm thinking about the other way around. I'm sorry.
Yeah.
Now you're twisting me. Now you got me in the twister.
So I got you in the arm bar.
You got me totally in the wrong way. All right. So I structured this way because if vol goes up, right, which is what I'm thinking, then to your point, and I use that terminology too, the 6400 wakes up before the 6300s do.
Yes,
right.
I agree.
And so that is the situation where that trade should make me money. Now, where I would start to, I mean, this is it's not a broken wing fly, like the strikes are equidistant. So the most here, I have a fixed risk in this case. But let's just say it was only the 1x2. If VIX did go to 80, then those 6,300 puts that I'm short, two of them, explode in value, and that would be that could be a kind of a widowmaker trade, right? If VIX did go to 80. So
correct.
That's the horrible scenario for me. Although since this is an equidistant put fly, in reality, I don't have this situation. But the 1x2, I would have that risk. And that is also the risk of trading the call 1x2s oftentimes in some of these names, like an open, where it could go to 40, even though it's a $10 stock. And so you're like, hey, I want to trade the call skew, and I'll buy one and sell two out of the money calls. But you don't want to be short two calls in a stock that has, in theory, unlimited upside. So that's that is the risk. Now, if the market goes down and vol doesn't do anything really, or doesn't really react, that's good for my position, right? Let's call it just the 1x2, which is a dynamic of the market that actually in 2022 was pretty prevalent. Like put skew didn't really react to down moves in the market, so that was kind of okay, right? And then in some of the other off moves we had, like in August of last year, put skew really didn't go. like there was a lot of backwardation. Longer dated options didn't seem to wake up quite as much. Which I guess in terms of this position, that wouldn't really affect me because I have very short dated options on. So not only do you have the dynamic of how is skew shifting, but also there's the time component where you could own a 2-month option and vol just doesn't ever do anything. And then so essentially what you have is like kind of like a delta trade on, I guess.
Agreed. I would say if we're going to talk about it in terms of like just the 1x2, that 1x2 probably makes the most money P&L wise when you get the delta move from the 64s, but you don't get the vol pop that makes the 63s go bid twice.
Yes.
Right. And so in that ultimate, like the ultimate scenario is the thing expands because I get more delta in the option I'm long, and the 2 options that I'm short don't go bid because they don't get a lot of delta and they're pretty close to expiration and people just assume they're going to go out worthless. Mm-hmm. Right. So the thing that I want people to remember is in situations when you're talking about out of the money put 1x2s or out of the money call 1x2s, it seems counterintuitive, but those things go bid to the 1 when vol goes down. And they go offered to the 1, meaning they get smaller in price when vol goes up, right? Because if you take the vol and you take it up, the 1x2, if you're long the 1 and short the 2, means you're short 2 options and long 1. You're actually short vol if you're long 1x2s most of the time.
Right.
And so you need to think about option 1x2s that are out of the money expanding when vol goes down and contracting when vol goes up, because the options that you're short, the 2 options are going to move more than the options that you're long because you're short 2 of them, right? So that's one thing that people that it seems very counterintuitive most of the time for people to understand that.
And this can also be the paradox with putting on even a broken wing fly, because that extra option that you buy as the margin call can oftentimes add a lot of negative P&L if vol does come in, right? Because that's the teeniest option that in the most explosive moves actually has a value, even though it kind of shouldn't have a value. But the market dynamics are making you get long an option at 400 implied vol, and that's going to be the first one that contracts, when the move mean reverts.
Yeah. One of the things I tell this story sometimes. This was a trade that I had on before Trump was elected the first time. And in the 10-year options, the call skew was completely through the roof. People were just like completely losing
their mind. This was the night of the election?
The day before. It was 2 days before and then the day before.
Okay.
And so what ended up happening was the call skew went like this. And at this point were I forget what strike it was. It was like the 125, 127, 129 call fly or something like that. And everyone in the pit was short the 127s. Everyone, in huge size. And it got to the point where the 120, I think maybe it was the 6, 7, 8 call fly. I don't remember. But I was sitting across from the guy who was running the 10-year desk. And he was like, that's weird. That call fly is only trading for a tick. And my ears, right? I was running a relative value book. My ears perked up. I was like, what did you say? What? Call fly is only trading for a tick. And he was like, the 6, 7, 8 call fly. And I was like, why? That seems really weird. He was like, everyone is short the 7s. And so everyone wants to sell the 6, 7, 1x2 because they want to sell the 6s once to get 2 of the 7s back because they're short massive amounts of 7s. And so what that did is it kind of cranked that call fly down in price because everyone wanted to sell the 6s to buy the 7s twice. So I bought a bunch of 6, 7, 8 or whatever the strikes were, call flies. And everyone was happy to sell it for a tick because they probably had it worth 3/4 of a tick on their sheets. And they didn't think about what was going to happen if Trump did get elected and the thing went through the strike all the way up to the 2 short strikes. They were just freaking out about their risk. And guess what happened? Exactly that, right? It went up. I had 45 minutes where it stayed up there long enough. The options were expiring that day. Mm-hmm. And to be able to get out of the call fly. And I ended up selling the call fly for 9, 7, 9, 7.5. I sold a bunch of them. And so that is the dynamic that I'm talking about when you're talking about skew, right? When people get lopsided one way or another, you can have situations where they don't think about the call fly. They only think about the 1x2. They're only thinking about like, oh, the 6-7 1x. I really want to sell this thing. And so you package it up as the 6-7-8 call fly and say, do you want to sell the call fly? Because I would love to buy the call fly, right? And they don't think about the eights. They only think about the 6-7 1x2. So, that can be a situation where things like that happen as well.
Is this skewed positioning, part of the reason that futures just went so unbelievably bananas like the night of the election?
Yep. Absolutely.
I hadn't heard anyone talk about that before. It's interesting.
Yeah. Everyone was short the upside calls in massive, massive size in the 10-year. It was like, I couldn't believe that they traded at that price. And I spent a day and a half the day before just buying it for one. I was like, just put in a bid, just buy 500 of them for one and see what happens. And they put the bid in, and it was like, bing, you're instantly filled. And then it was like, okay, well, see what happens. See, can I buy 500 more? And then it was like, bing, you're filled for 500 more. I was like, oh man, and I started, and listen, I wasn't hedging them, right? So it was like, I'm just paying a tick for as many of these as I can get my hands on. And eventually people started to get wise to it because I bought a bunch of them over the course of a day and a half. And then I told like some of the people in the firm, right? I was like, can you believe they're trading a tick? And then everyone started buying them, right? And then it was like, oh, the cat's out of the bag. And for a while, it looked like a horrible trade, right? It looked like a horrible trade because it went all the way through all three strikes at first. And then it came back and settled into that short strike area where it was like, oh, here we are. What are you guys going to do now? How's the 6-7 1x2 now, guy? So anyway, that's a good war story for situations.
Great story. Like I like it. I hadn't heard that about the election.
People love the war stories, the option war stories. Soon we're all going to be dead and no one's going to care about those.
Well, just AI Matt can tell stories then.
AI Matt can tell the story.
Can hallucinate stories.
Yep. I listen to a lot of there's a podcast called the Hard Fork Podcast from the New York Times. That's two guys that talk about AI constantly. Their recent guest is just like such a massive AI doomer. It was amazing. His book is called like If You Build It, We're All Dead. Which is like a great title for a book. So anyway, AI Matt can tell the stories because we're all going to be dead. So I think that's all I got for you today, Brent, unless you want to talk more war stories.
No, I thought that that this was a fantastic conversation, and I know we're coming up against the top of the hour here. And so, sorry, there's unlimited construction happening right next to my microphone. I hope that's not too brutal to listen to here.
I love it.
Let me get this all squared away. So that was a real power hour. I learned a bunch of stuff, terminologies, and better ways to, I think, describe what it is I was trying to do. And so I found this very valuable. And so I'm sure a lot of the people watching, and we had a lot of people watching today. So thank you for joining us to do this. And we will continue to do more of these sessions with you as long as you've been very gracious in joining us. This man's got a busy schedule. He's doing a lot of content, and so I appreciate you taking the time.
I'm happy to do it anytime our schedules align. I'm in. You can always call me.
Yeah, thank you. Now, for tracking all the content you put out, I know you're a big LinkedIn guy. You also got a nice X presence you're building too. So where can people find out more from you?
Yeah, absolutely. You can find me, Matt Cashman, on LinkedIn. I spend a lot of time writing LinkedIn pieces and putting out content there, and then also on X, as Brent said. I forget what you can find me on X as well. But one other thing that I want to draw people's attention to is the Options Industry Council and OCC, where all of this, what you're seeing here on the screen is stuff that I create, but it's all property of the OCC and the OIC, and it's all hosted on their website, which is optionseducation.org. Make sure you check that out because it has all kinds of educational content. Much of it that it looks an awful lot like this, that you can find their webinars and podcasts and videos and all kinds of things there. So check that out as well.
That's awesome. That stuff was all a little basic for a long time, and now it's getting more advanced. And I really like finding some of the stuff in there. And for SpotGamma members, we will see you. We have an OPEX video this week, so we're doing OPEX live either today or tomorrow. I forget. I got to check that, and then we'll have our normal webinar on 1 p.m. If you have any questions, info@spotgamma.com. We're happy to help you out. And thanks everyone for watching. Matt, thank you again for your time, and we'll catch everyone later.
Thanks a lot. See you guys around.